Her name was Patricia. Patricia Guerrero worked 31 years as a registered nurse in Columbus, Ohio. She clocked double shifts. She skipped vacations. She packed her lunch every single day for 3 decades. By 2019, Patricia had managed to save $63,000 in a savings account at her local bank. $63,000 of hard-earned, carefully protected money sitting completely still. When Patricia retired in 2020, her financial advisor sat her down and showed her something that changed her life. If Patricia had invested that same $63,000 into a basic S&P 500 index fund starting in 1989, that money would have grown to over $900,000 by the time she retired. $900,000 from the same $63,000 she already had. Patricia did not lose money to bad investments or reckless decisions. She lost nearly $1 million to one thing: inaction. And here's the part that will stop you cold. Patricia is not unusual. Patricia is most Americans. According to Gallup, as of 2023, only 58% of Americans own any stocks at all. That means more than 4 in 10 adults in the richest country on earth are not invested in anything. Not a single share, not one index fund, not a dollar working for them in the market. And when researchers dig into why, the answers are not what most people expect. It is not because people cannot afford to invest. It is not because they lack access. It is something far deeper, far more psychological, and far more fixable than anyone wants to admit. So today we are going to talk about why most Americans never invest, even when they absolutely can. And more importantly, what you can do starting this week to make sure you are not still making this same mistake 30 years from now. Because the gap between the people who build wealth and the people who wonder where their money went is almost never income. It is almost always behavior. Let us start with the most common reason people give, and it sounds completely reasonable on the surface. Most people say they do not invest because they do not have enough money yet. They are waiting until they have more, until things settle down, until the debt is paid off, until the kids are older, until next year. This idea has a name in psychology. It is called present bias, and it is one of the most financially devastating forces in human behavior. Present bias means your brain naturally overvalues what you need right now and undervalues what future you will desperately need later. Dr. Shlomo Benartzi, a behavioral economist at UCLA who has spent decades studying retirement savings, describes it this way. People consistently choose $100 today over $150 in a year, even when they know mathematically that waiting is the smarter choice. The future feels abstract. The present feels real. And so Americans keep waiting for the perfect moment to start, and that moment almost never comes. The Federal Reserve's 2022 Survey of Consumer Finances revealed a striking pattern. The median American family had a net worth of approximately $192,000, but that figure includes home equity. When you look at median liquid financial assets alone, the number drops dramatically. And families who started investing in their 20s, even with small amounts, built dramatically more wealth by retirement than those who waited. The difference was not how much they earned. The difference was simply when they started. Now, the second reason runs even deeper than timing. And this one is the one nobody talks about out loud. Most Americans do not invest because they are afraid. Not afraid in a vague, general sense. Afraid in a very specific, very personal way. They are afraid of losing money they worked incredibly hard for. They are afraid of making a mistake they cannot recover from. And here's the thing, that fear is completely understandable. Because for many Americans, especially those who grew up in households that struggled financially, money was never something you played with. Money was something you protected. You held it close. You kept it somewhere you could see it and touch it, because once it was gone, there was no safety net. This phenomenon has been studied extensively by researchers at the National Bureau of Economic Research. They found that people who experienced significant financial hardship early in life, whether personally or through watching their parents struggle, were dramatically less likely to invest in the stock market even decades later, even after their own financial situation had stabilized. The fear gets wired in early, and without something actively rewiring it, it just stays there. Think about what happened during 2008. The financial crisis wiped out trillions of dollars in retirement savings almost overnight. The S&P 500 lost roughly 50% of its value between October 2007 and March 2009. Millions of Americans watched their 401k statements become painful reading, and many of those people never went back. According to Vanguard Research, a significant portion of investors who liquidated their portfolios during 2008 never reinvested that money at all. They absorbed the psychological wound and decided the market was simply not for people like them. But here is where it gets interesting, because the data tells a completely different story from the fear. The S&P 500 recovered fully from the 2008 crash by 2013. And by 2023, it had returned roughly 500% from its crisis lows. The people who stayed invested or who started investing during the crash when prices were low did not just survive. They built life-changing wealth. The market has never failed to recover from any correction in its entire history, not once. But that truth never quite drowns out the fear. And yet, even people who have worked through the fear still fall into another trap. And this one might be the sneakiest of them all. It is the trap of complexity. So many Americans believe that investing is something you have to fully understand before you can do it, that you need to know how to read earnings reports, that you need to understand options trading and price-to-earnings ratios and sector rotation, that if you do not know what you are doing, you will make a catastrophic mistake. And so they keep putting it off because they keep waiting to feel ready. Here is what the data actually shows. The average actively managed mutual fund run by professional investors with research teams and decades of experience has historically underperformed the S&P 500 index over any 20-year period. That finding comes from S&P's own SPIVA report, which tracks this comparison year after year. What that means is that the average professional investor, with all of their expertise and sophistication, does no better than a simple, low-cost index fund that a complete beginner can buy in minutes. You do not need expertise to invest wisely. You need consistency and time. That is it. John Bogle, the founder of Vanguard and the man who popularized index fund investing for everyday Americans, said it plainly. He said that the index fund is the most rational investment for almost all investors because it captures the entire market's return while minimizing costs and eliminating the need for stock-picking skill. And Bogle built a multi-trillion-dollar company on that exact idea. Vanguard now manages over $8 trillion in assets. $8 trillion built on the premise that ordinary people do not need to be experts. They just need to stay in the game. All of that becomes even more powerful when you understand what time actually does to invested money. This is where most financial conversations stop at the surface level, and we are not going to do that today. There is a concept called compound interest, and while you may have heard that term before, most people have never truly felt it in their gut the way it deserves to be felt. Compound interest means that your investment earns returns, and then those returns earn returns, and then those returns earn returns. It is not growth in a straight line. It is growth that accelerates on itself like a snowball rolling down a mountain. Here is what that looks like in real numbers. If you invest $300 a month starting at age 25, earning an average annual return of 7%, which is roughly the historical average of the S&P 500 after adjusting for inflation, by age 65, you would have over $750,000. But if you wait just 10 years and start at 35 instead, that same $300 a month at the same return gives you only $375,000 at 65. You invested for 10 fewer years, but you ended up with nearly $400,000 less. Those 10 years of delay cost you more money than the total amount you would have invested in your entire life. That is the violence of waiting. That is why Patricia's story matters so much, which brings us to the most important part of this conversation, what you actually do about it. Because understanding the psychology is only useful if it changes your behavior. So here is a concrete step-by-step plan you can start this week, not someday, this week. Step 1, open a brokerage account today, not next week, today. If your employer offers a 401k with a company match, that is your first stop. A company match is free money, meaning your employer adds money to your retirement account based on what you put in. According to Fidelity, roughly 20% of employees who are eligible for a company match do not contribute enough to get the full match. That is leaving free money on the table. If you do not have access to a 401k, open a Roth IRA instead. A Roth IRA is an individual retirement account where you invest after-tax money and your money grows completely tax-free. Fidelity, Schwab, and Vanguard all allow you to open a Roth IRA online in under 15 minutes with no minimum balance required to start. Step 2, buy one thing, just one. Do not try to build a sophisticated portfolio on day one. Buy a total market index fund or an S&P 500 index fund. At Fidelity, you can buy FSKAX, which is the Fidelity Total Market Index Fund with zero expense ratio. At Vanguard, you can buy VOO, which tracks the S&P 500. These funds give you instant ownership of hundreds or thousands of companies across the American economy. You are not betting on one stock, you are betting on America's economy as a whole. And over every 30-year period in recorded history, that bet has paid off. Step 3, automate the contribution so you never have to think about it again. Set up an automatic transfer from your checking account on the same day every month, ideally the day after your paycheck clears. Behavioral economists call this strategy pay yourself first, meaning you treat your investment contribution like a bill, not like something you do with whatever is left over. The Bankrate financial planning team consistently recommends automating savings as the single most effective way to build long-term wealth because it removes the decision entirely. You never have to feel motivated. The system does it for you. Step 4, start with whatever you can, even if it feels embarrassingly small. $25 a month, $50, $100. The specific number matters far less than the habit of doing it at all. Remember the SPIVA data. The secret to long-term wealth is not picking the right stocks, it is staying invested consistently over time. A small amount invested today is infinitely more powerful than a perfect strategy you start 5 years from now. Step 5, protect your mindset during downturns. This is the step most guides skip entirely. The market will go down. There will be a month, maybe a year, where your account balance drops and it feels terrifying. Have a plan for that moment right now, before it happens. Write it down if you have to. Your plan is this. When the market drops, you do not sell. You keep contributing. Because every dollar you invest during a downturn buys more shares at a lower price, which means you benefit more when the recovery comes. Warren Buffett, arguably the most successful long-term investor in American history, has said repeatedly that the stock market is a device for transferring money from the impatient to the patient. Your job is to be the patient one. Here is what all of this comes back to. Patricia Guerrero worked 31 years and saved $63,000 out of sheer discipline and sacrifice. She did everything right, except one thing. She never put that money to work. And by the time she found out what she had missed, most of the time had already passed. You still have time. The question is what you do with that time starting right now. The invisible barrier between you and a genuinely different financial future is not income. It is not complexity. It is not risk. It is a decision you make this week to stop waiting and start. The market does not care about your fears. It does not care about your past. It only rewards the people who show up and stay. Now, I want to hear from you. Drop a comment below and tell me, what has been your biggest reason for not investing yet? Is it fear? Is it not knowing where to start? Is it waiting until you have more? Whatever it is, Say it out loud in the comments because I guarantee someone else watching this right now feels exactly the same way. And you might just be the person who helps them take the first step. And if this video gave you something real today, something you can actually use, hit subscribe because next week we are talking about the exact 401k mistakes that cost Americans thousands of dollars every year without them ever realizing it. Mistakes your HR department is definitely not warning you about. You are not going to want to miss that one. Let us build something real. We will see you on the next one.